Hello, folks. This is Steve Memory from Iconic Wealth Management with an educational economic update for March 2018. In this month's video, I'll discuss some of the major headlines that influence markets in February. I will also provide insights into what these developments could mean for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. Domestic markets started 2018 with their best monthly performance since at least 2016, only to stumble in February. Both the S&P 500 and Dow had their first monthly losses in 10 months, breaking their longest winning streaks since 1959. Overall, the S&P 500 lost 3.9%, the Dow dropped 4.3%, and the Nasdaq gave back 1.9%. These losses came as volatility picked up throughout the month. In early February, we had experienced back-to-back stock sell-offs, followed by large jumps. During 1 week, the Dow lost 1,000 points and gained 300. Twice. But this volatility wasn't the result of negative economic data or geopolitical problems. Instead, a combination of emotional investing and computer-generated trading may be to blame. Essentially, investors became concerned about inflation when the labor report indicated that wage growth was picking up. Still, the bull market abides. In fact, the S&P 500's bullish run that started on March 9th of 2009 recently celebrated its 9th birthday. Only one other bull market in nearly 100 years lasted longer. And if this bull can remain alive, by early September, it will inherit the title Longest Bull Market in a Century from the 113-month bull market of 1990 to 2000. Thus far, this bull gained 325% in price through January 26, 2018. That's the most recent all-time high, making it the second greatest bull market since World War II. Does this mean it's time to panic? Historically, recession is the great toreador that brings most bull markets their demise, and while volatility may have drawn blood in the arena, recession has not yet entered this ring. In other economic news, we received a variety of positive and negative reports. The most recent data for housing showed both new and existing home sales dropped in January. Housing starts, on the other hand, hit their second highest rate since the recession. We also received the second reading of fourth quarter gross domestic product, GDP, at 2.5%. The growth matched expectations. Ultimately, though, worry about inflation and the resulting potential for interest rate increases contributed to much of the month's volatility. Now, by the end of February, comments from the new Federal Reserve Chair Jerome Powell led some investors to believe interest rates may, in fact, rise faster than anticipated. In testimony to the House Financial Services Committee, Powell spoke of growing global strength and stimulative fiscal policy. He also said that inflation may be moving closer to the Fed's target rate. This positive view of the economy could potentially result in 4 interest rate increases in 2018. On February 27th, stocks dropped significantly in response to Powell's testimony. The volatility continued the next day as stocks whipped back and forth before ultimately ending down. If February's volatility feels unnerving, that may be due to the market's unusual calm in 2017. Since 1980, the average annual S&P 500 correction has been approximately 14%. Last year, however, stocks only fluctuated 3%. Even so, expect volatility to remain the order of the day, particularly in light of the recently announced tariff proposals. The March 13th political headline that the White House could announce steep tariffs and investment restrictions on China as soon as next week served as a sobering reminder that the trade war issue is still simmering and could soon hit a boiling point if China decides to retaliate. Meanwhile, the Consumer Price Index for February offered up some breathing room. as it showed that consumer inflation is accelerating at a manageable pace. The CPI increased 0.2% last month, as expected, after rising 0.5 in January. Meanwhile, the core CPI, which is seen as a better long-term gauge of inflation as it excludes the volatile categories of food and energy, also met expectations with a 0.2% month-over-month increase. Now, this was down from a 0.3% increase in January. When considering last month's fluctuations, remember that the positive economic perspectives were behind much of the movement. Despite the volatility, consumer confidence easily beat expectations and showed that people feel particularly good about the labor market. Jobless claims supported this perspective as new unemployment filings remained near historic lows. Moving further into March, we will be paying closer attention to inflation, interest rates, and investor behavior. On March 21st, the Fed may raise interest rates again and provide greater insight into their expectations for the year ahead. As these developments arise, we will keep you informed. That's it for this month's Educational Economic Update. Once again, this is Steve Memory with Iconic Wealth Management, signing off for the month of March 2018. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 703-891-9518. We're happy to talk to you.